Yes, sir.
To add to that, but if you start double closing, wouldn't that show up as real estate on your balance sheet? Let's say, for instance, for REOs.
What do you mean by double closing?
Well, if you take possession of a foreclosure, basically wholesaling a foreclosure or REO, you personally, your business has to take a hold of that property per se, just depending on how the deed is structured.
I will say this, and I'm going to answer the question generally. The odds of you having a bad tax outcome in any of the things we just talked about, including what you just talked about, the odds of you having a bad tax outcome if you use a C corporation or even an S corporation are going to go up materially, if not astronomically, if you use a C corporation or S corporation, as opposed to an LLC, for example.
Right.
You're just much less likely to have a footfall or a disaster with an LLC on the tax side than you are with those entities. Yes, sir.
A question I have: if you're considering a C corporation or S corporation, I might be in ahead of what you're going to say. Isn't an LLC the best option to go?
Funny you should ask that. Yeah, we're going to talk about. Yeah, you're getting ahead. We're going to talk about that.
I'm ahead of myself, but is that a yes or a no?
Wait. All right. So, but that's a great segue because my third rule is do use, and I got it in quotation marks, partnerships or nothing. And I want to talk about that a little bit. So when you see partnerships up there in quotation marks, what I mean is an entity that the federal government treats as a partnership for tax purposes, which would include the following. It would include a limited liability company, it would include a general partnership, and it would include a limited partnership. Okay, so if we're just wearing our tax hat right now, okay, we're not thinking about any other factors. We're not thinking about management. We're not thinking about finances. We're not thinking about liability. We're just thinking about taxes. What I'm saying is, you're generally going to stay out of trouble if you start with an entity that the feds treat as a partnership: LLC, limited partnership, general partnership. Okay, or I've got nothing. About nothing up there. A tax nothing is another name for a disregarded entity. If you have a single member LLC, which you can have. Let's say you want to just do a deal yourself and you don't want to be personally liable. You want to try to get some liability protection and it's just you, and so you want to use an LLC and you're the sole owner of that LLC. That single member LLC for federal income tax purposes is a disregarded entity. It is a tax nothing, and you're going to report the income, gain, and loss from that activity on Schedule C of your personal income tax return. Okay? So, no, if it's got two owners, it's going to be treated as a partnership. Okay? And that's actually, I mean, that's a good point. So you give me far afield on it. All right, so, but that's a good point. If you cannot have a partnership, whether it's a partnership in quotation marks, because it's in this context a real partnership, unless you have at least two people, two legal persons. Okay, and I will say, if you have two legal persons who are who are engaged in some business where they have an agreement to share profits and losses, you have a partnership under state law. All right? Whether you even know you have a partnership or not, whether you call it a partnership, even if you think you don't have a partnership, the state of Tennessee says that if two legal persons pursue a activity for profit with an agreement to share profit and loss, they're engaging in a partnership, which means that since you're a partner, you're jointly and severally liable for everything that partnership does with the other owners. And so if you don't want that outcome, you got to go do some of this planning. All right. Rule 4 is, don't forget the Tennessee Department of Revenue. We had, in my world, which is, as Joe said, primarily a commercial real estate world, we spend a lot of time dealing with Tennessee franchise and excise tax laws, all right? Because The franchise tax is $2,500 per $1 million of value with no deduction for the mortgage balance. And the excise tax part is 6%, essentially NOI from the project. So if you got a $20 million building, that's got $200,000 of NOI, that means we got $50,000 of franchise tax, and we got, I said it'd be $2 million in NOI. If we had a $20 million building, we got $50,000 of franchise tax, and we got $120,000 of excise tax. So we got $170,000 a year F&E tax bill for that project, that $20 million project, which is super painful. Right? And so, and I will tell you, out-of-state institutional investors come to Tennessee, and this is always a little bit of a mood-killing discussion that we have with them. And so we spend a lot of time trying to plan around it. There are some good, obviously, if you're talking about, well, I'll say this, if you're talking about going out and buying $1 million worth of investment property, let's say you got $1 million worth of investment property, and that is producing $100,000 a year in NOI. You got a $2,500 franchise tax issue, and you got a $6,000 excise tax. You got an $8,500 a year issue, and that's like real money. All right, so it's an important issue for everybody. We have it's generally easier to avoid and much less punitive in the context of single-family residential investing than in other areas of real estate, and we're going to talk about this in a little bit more detail. But don't forget about it. Right? And then the fifth thing is don't forget about 1031 plan. Yes, sir.
Pose a quick question. So, with the LLC enhanced, can you structure the bylaws and the articles where you can figure out the participants, their roles, and different things like that? Are you going to talk about that?
Yes.
Okay. Thank you.
And the final tax point here is don't forget about planning for 1031 exchanges. All right, a 1031 exchange is that's section 1031 under the Internal Revenue Code, which is an exchange of like-kind property, which allows you to defer gain. If let's say I've got a building that I've got low tax basis in it, I've got a $200,000 gain on, I can go out, I can sell that property, I can do that as part of a 1031 exchange. I can roll over the proceeds from that sale into replacement property, defer the tax on the $200,000 in gain, and not pay that tax until I sell the replacement property down the road, and I can then roll that over to a 1031. So the only point is, if you know you're going to be selling appreciated property, realizing taxable gain, and plowing the proceeds back into replacement property, you need to be thinking 1031 along the way, because that's going to allow you to defer that tax. Yes.
There's a window on that.
Yeah. So on a deferred exchange, which is what we typically do, you've got 45 days after you close the sale of the relinquished property to identify up to 3 replacement properties. And you then have to close on one of those replacement properties within 180 days after your original sale of the relinquished property. And if you don't, you just end up with a busted 1031 and you got to pay. And it's not like something bad happens, other than you got to pay the tax. But that's what happens if you don't make those deadlines.